All right, guys, we are back. Brett Reichel, 2 years in a row?
Three.
Three years in a row.
Yeah.
Okay, so you're back.
Hooray.
You're absolutely.
Yeah.
He's my long lost brother. So,
Yes.
All right, guys, so we've got Brett Reichel, Loan Depot, branch manager with Loan Depot,
Yep.
43 years in the business.
Yep.
Wow. Okay, so I think quite honestly, this may be the title that you may not want, but I think you may be the person I'm interviewing who has been in this business the longest.
It wouldn't surprise me.
And I'm pulling up a short distant second at about 35 years. So at any rate, thank you for coming back, Brett.
My pleasure.
So
Happy to be here.
well, thanks for being here. So we're back in studio. Again, we just missed the possible, let's do a live event somewhere, and we just kind of, with the variant of COVID and setting venues, so here we are. So hopefully next year we'll be live somewhere and we can do this and actually shake some hands. Let's just jump right in. So what I've been doing with pretty much everybody on the forecast so far is taking a look back. Now, you were here last year.
Correct.
And you were here the year before.
Correct.
Okay, so not every speaker that I've had has actually been here in 2020, which was the panic year. I mean, because our forecast was like the week after the lockdown. And then 2021 was, 1 year of COVID behind us, and we realized that business was ridiculously fantastic. So let's do a 24-month look back. So how has the mortgage business been in 2020 and 2021, and then maybe we'll start talking about what we expect. So great couple of years.
Without a doubt, yeah, the best in the history of the mortgage business. So
the best in the history.
yes, so it's
Right.
2020 was interesting. We did one of these presentations or interviews in the studio,
Yep.
and I came back 2 weeks later to redo it because everything changed in 2 weeks.
I forgot about that.
Yeah,
That's
everything
right.
changed in 2 weeks. And,
Yep.
And so that was fascinating to me that we had to redo it. But we had some real big worries in 2020, especially when all that stuff hit. We had interest rates change 400 basis points in one day in March 2020 on the price side of it, not the rate side of it. We had some worries about whether mortgage companies would be able to stay in business because of forbearance, and they're having to fund the forbearance for the federal government.
Right.
And they managed to survive it because interest rates went down, and we did so much volume that it.
So you guys did have, I forgot about that. So you guys had that window of time where there was truly, you were going to have to take on a larger burden of,
Sure.
of the responsibility of these, but that was very early on in COVID. So that was what, like the first few months of 2020, and then we kind of figured it out and
Yes, they figured it out. It's several levels ahead of me, but they figured it out, and I really think what happened is the margins in the mortgage business went through the roof in
Right.
2020 and 2021, and the money was great, and the
Right.
mortgage companies made a lot of money.
Okay.
And so, that covered a multitude of sins.
Right. Interesting. So basically, your words were not record breaking, the best years in the history.
Yeah,
Is that
2000? I think it was 3 was close.
okay?
So 2020, 2021 were the same or better.
That's a very interesting. Why would you bring up a year 3 years before the Great Recession or 4 years before the Great Recession?
I'm not predicting anything.
You're going to have people talking. It's you made me think of something. So I'm going to segue. I went to see Chris Thornburg speak in preparation. He's going to close us out here on April 6th.
Great.
And he did a talk about 2 weeks ago for CORE. Can't remember exactly what CORE stands for, but real estate industry, I think commercial guys over in Ontario. And he made a reference to a talk that he had done in 2005. And he compared it to today. And during his talk, I texted him. During the talk, I'm in the audience. And I'm like, do you realize when you, Chris Thornburg, make a reference to 2005 and you compare it to where we are today, that anybody who was paying attention and knew what happened after 2005 just immediately had a panic attack? And he kind of, I don't know whether that was his intention, but I immediately said, oh, my ears perked up. And I said, what are you going to say? So I'm not in the mortgage business, but I do remember 2003. And I certainly remember 2000 and 2001 and 2 and 3 and 4 and 5 were pretty extraordinary years.
They were great years
in the real estate business. So you're comparing 2020 and 2021 as some of the best years ever to what sounds like, which I don't remember it on the mortgage side, a best year ever, 2023.
Yeah.
So what comparisons can we make? So what does that mean, Brad? So so drop a bomb on us.
Well, I don't think it compares. It compares purely in volume and units and things like that.
Yep.
I don't think it compares in pretty much any other. Well, who knows? Chris might come up with something, but
Yep.
from my perspective, the difference in the mortgage world in 2003 is significant in that, we qualify people now.
Right.
We didn't necessarily qualify people in 2003.
Right.
The qualification standards, we'll say we qualified them, but they were much, much more liberal. There was, zero down. There was. Which I don't really think caused the problem. I think it was more the income-derived things that caused the problems.
Right.
The lack of cash in the bank.
Okay, I'm being a little
Yeah.
hyperbolic. Okay.
Yeah,
I'm,
so
I'm
I-
not trying to draw
Yeah,
comparisons.
I just don't see that there's a drastic comparison to that time. So.
Okay, so let's bring it back to 2022.
Okay.
So last couple of years, fantastic. And by the way, everybody in our business, I mean, the residential real estate sales, just off the hook, record-breaking years. I had Ido Benzivi in here a couple of weeks ago. He's in commercial, industrial, just unbelievably busy, very productive, profitable years. Title company just left, Orange Coast Title, very profitable years. Okay, so certainly to my surprise, I wasn't expecting 20% property value appreciations. I wasn't expecting the demand. I certainly wasn't expecting interest rates to go down into the twos. At some point, I suppose you probably funded some loans sub 2%. So there we are. But now things seem to be shifting a little bit. So we've got inventory problems, which we'll talk about. Again, today is March 22nd. Brett's interview is going to air probably about 4 or 5 days from now, so God knows what rates will be. But are we a little north of 4.5% on a 30-year fixed?
Yeah, it depends on who you
right
talk
now?
to and what you listen to, but the Freddie Mac average is like 3.9 with 0.8 points. That's a quote. Optimal Blue is an index that I've been following lately. Optimal Blue is a company that manages pricing and locking or maybe not locking, but pricing and the sales force communicating with the lock desk and then with investors. And they probably manage about 35% of the transactions in the country because they're very big, and many of the big independent mortgage bankers use them. And Optimal Blue has an index every day. It was 4.61 today.
Is that something that's available to the public?
Yes.
If they did a search on Optimal Blue, they could kind of see.
I can send you the link. I Googled it and found it myself. So someone mentioned it in an interview I had heard, and I thought, hey, that'd be an interesting one to follow.
Yeah.
Because that covers not just the best of the best. That's the 680 FICO cash out guy, the whole 9 yards.
Right.
So where
we had briefly touched on this before the interview. We did about 2 minutes of kind of let's game plan before we sit down and talk. And I'm paraphrasing, but you're like, there's a lot of companies out there that are marketing, basically unobtainable interest rates. Hey, come with us, and this is what we're going to give you. And I don't know what you got to do. I don't know if you need to have huge down payments and 850 FICO or whatever it happens to be. But what's the website again? Optimal?
Optimal Blue.
Optimal Blue. So that rate of, let's just call it, what'd you say, 4.5?
4.61.
4.61. That's probably a rate that your average consumer with reasonable credit could assume to be quoted if they're in the market today.
Very common, yeah.
Very common, okay. Which is, by the way, that's what, 1.5 higher than where we were 60 days ago, 90 days ago, for sure?
1.5, yeah.
Yeah, give or take. So we
Beginning
were
of
in
the
the
year.
low threes, and now we're mid fours.
Yep.
One of the things with just pure volatility that does concern me a little bit, and we can talk about how great things have been, and now we're looking at 2022, and I have some concerns. I have some inventory concerns. I have inflation concerns. I have Russia concerns. I have a variety of things that say, okay, what are we going to do price-wise? I don't want to see another year of 20% appreciation. Back to back, 20%, 20%. There are some economists out there predicting, double-digit appreciation. CAR is predicting a 5% appreciation. It seems conservative based on the other things I've seen. But they're also predicting a 5% fewer unit sales in 2022. So higher prices, fewer sales. Is that inventory?
Makes sense. California's expensive.
It does. So on your side of the business, and I don't pretend to be an expert on the mortgage side. Forget about the actual, mechanics of the mortgage, the actual business. What's it take to be profitable and keep loan officers employed? What do you feel if you want to go that far? What are you feeling for 2022? Is it going to be another? What did you say? Not record breaking, best year ever?
No.
It's not.
No, it's going to be a very good year
Okay.
historically. But it's going to be a hard year for mortgage companies.
Yep.
So it's going to be a very good year in that we're going to do, probably the fourth or fifth best volume ever because the purchase market's so good.
Okay.
We'll still do a lot of cash out refis, that are
Yep.
debt consolidation type ththings, remodel your house type of things.
Yep.
So that market's still very active and still very busy, and we're doing a lot of those loans. But refinance activity just refinance activity overall is down 50%.
Right. 50.
Yes.
Right.
Yeah,
Okay,
a little bit more.
So again, I confessed earlier. I'm thinking refis are done. Who's going to refi? But then you said, well, could the people who are doing cash out refis who are,
you might have a 2 3/4% interest rate on your mortgage,
Right.
And you might have 10 Visa cards that are at $5,000 each
Yep.
that are maxed, and you're making a minimum payment on. You know what you have when you have
Yeah.
those? You have 10 cards that you owe $100,000 on,
Yep.
that you have a 28-year term on,
Right.
where the interest rate is variable, in a market where the Fed's raising the interest rates. And you're already at 16, 17, 18, 19, 20%.
Yep.
So it makes sense for a lot of people to cash out refinance.
It'd be interesting because I'm not prepared for this part of our interview, but I think this is something that I'm going to ping you on periodically throughout the next year to see, are those cash out refis increasing? And if they just make financial sense and the borrower's healthy, because like you said a minute ago, you're not doing bad loans, right? You're not
No.
doing loans that are, going back to that, a little silly jaunt for 2003 and 2004. There were a lot of loans that probably shouldn't have been done.
100%.
So now we're doing loans that should be done. But I will tell you, if you and I are talking 3, 6, 12 months from now, and you're doing a large amount of cash out refis because people are doing the credit cards, it's one thing I want to put on a patio, but if I'm paying off a lot of high interest credit cards, which by the way is the right thing to do, but it scares me a little bit because now whatever equity that they had built up in this run up, well now they've spent it. They're refining the boat that they probably shouldn't have bought.
Which is what we were worried about in the 2000s.
Correct.
The boat, the jet skis, the
Right.
truck, the
The
wheels
RV.
and tires,
Right.
the great stereo in your truck. Yeah.
Right. Yeah.
Big
People
screen
were
TV.
renting those spinners, right?
Yeah.
I saw a set of those going down the freeway the other day. I said, man, that
I
brings,
forgot about those
that brings
completely.
back memories. There was a place on Sunapee Boulevard where you could rent those things.
Yeah,
Anyway, I digress. Okay, so refi market's down about 50%. So
Correct.
that's gotta hurt the business a little
Yeah,
bit.
we're figuring overall the business will be down. I think the Mortgage Bankers Association figured the business would be down 25% this year.
25%.
Yeah.
Okay.
Which, everybody built up capacity. I don't know if you remember, but, for some time in 2020, most lenders were 60 to 90 days to close.
Right.
And because we just didn't have capacity to handle all the business.
Right.
So we built up the capacity. We had a great year. We finished off the year great. We closed a lot of loans on time this last year, closed great volume. All of a sudden, 25% of your business is gone.
Right.
You've got too much capacity.
Interesting. Well, I've been stealing, and Chris is going to be upset with me. Chris Thornburg's going to be upset with me. I attended one of his forecasts a couple weeks ago, and I'm stealing something from his. He starts his forecast talking about the narrative, okay? And his kind of presentation is built around, what's the media narrative in real estate? What's the consumer's narrative? Is real estate a place to be? Is it overheated? Is it a bubble? And in effect, what's basically the trending thought in the market? One thing that worries me a little bit is when I hear or see news articles or posts that say the mortgage industry is going to have to lay off X amount of their loan officers, or business in the mortgage industry is going to be down 25%. It's a little out of context because I think a lot of consumers, and even the people who are reading that news, it's like, well, okay, well, let's explain why. Well, because we don't have 2% interest rates to refi on. We have a little bit less inventory. But I get concerned that a consumer might say, oh, there's a problem with the mortgage industry. And next thing you know, they're talking foreclosures and there's a bubble.
Sure.
And why is there a problem in the mortgage? Well, it has nothing to do with residential resale necessarily. It just has to do with things have changed a little bit.
Capacity.
Capacity.
Yeah, we had overcapacity.
Yeah. So, we've been talking about this for a bit. And I've actually been talking about this for longer than you and I have been hanging out, which has been a bit. And one of my concerns in this, let's just say a transitioning market, is when we go from a sub 3% interest rate and in effect free money. I know it's not free, but it feels like free.
Yeah.
What happens when we're at 4? What happens when we're at 4.61? What happens when we're above that number? And what is the narrative? And what is ultimately, how is the consumer going to respond to that? Because as someone who's been doing this for 43 years and 35 years, I just sit back and say, well, geez, yeah, you can get a 4.61% interest rate. If that's the house you want, that's a great rate.
Without a doubt, yeah.
You know, you can get a 5%. My wife and I bought a house, many years ago. Whenever you could get a rate at 5.25%, however many years ago that was. I think we refied into 5.25%. And I literally was like, 5.25%. Never, ever going to be able to get a better rate than that. And but things change.
They do.
So I believe the Mortgage Bankers Association and California Association of Realtors, unless they've updated it, we're talking about interest rates at around 4 at the end of this year. Now,
correct.
Now, granted, that was probably 4 months ago that they made that. What are you seeing? I mean, it feels to me like rates are going to continue to charge up from where we are.
Yeah, I think so. The last time we had inflation at the levels we have now was 1984.
Yep.
So last week, they announced last month's inflation numbers are 7.9%, same as some month in '84. And interest rates in 1984, I was selling interest rates were 15.5 on a 30-year fixed.
Okay.
And I had a great product, a 1-year adjustable at 11.5. Everybody in town wanted.
Right.
And
the old adjustable rate product.
yes, it was awesome. And that's
yeah.
where I learned what it was and how it worked and how to explain it. And it was a great product because from that point on, interest rates went down overall.
Right.
But, that's where things were. So is there room for rates to go up? Absolutely, because people, if the markets get baked in expectations that rates and expenses and pay for your employees is going to go up, they're going to build that in. And we had to wring it out of the economy in the early 80s.
Right.
And hopefully we don't have to do that. Hopefully we're not at that point yet. If the Fed's aggressive, I'm hoping that they will cap out our interest rates a little bit, and we'll see that inflation number come back.
Right.
But it remains to be seen. It remains to be seen. I think at the beginning of the year, you asked in one of the sales meetings what I thought interest rates would be by the end of the year, and I said somewhere between 3 and 7/8 and 4. A bunch of the people in the room laughed. I think you laughed.
Because that was high.
Yeah, I think you
Right.
laughed. Yeah. And
I'm always laughing.
Yeah. And in any event, we ended up at 3 and 7/8 and 4 in February.
Yep, smart guy.
Yeah. Well, I don't know about that, but I got that one right. And it looks like they're going quite a bit higher, in my opinion. I mean, I wouldn't be surprised to see in the end of the year 5.5.
Yeah.
So.
Yeah. Do we really know what that means, though? What does that do to the psyche? What does that do to the narrative on the consumers right now?
When we were at 5.5 before, we didn't have 20% appreciation for 2 years in a row.
Right.
And so that's in people's minds.
Yep.
And that's different. That's what was in people's mind when I got into business in '79, is houses always go up.
Right.
And so, maybe that will keep fueling the market a little bit.
I'm hoping to interview Bruce Norris sometime in the next couple of weeks. He has his event going on right now, his boot camp in Florida, so maybe next week I'll get Bruce in. But Bruce has some charts, and for those of you that have been following the forecast for years, you've heard me talk about Bruce's charts, and you've seen Bruce present his charts.
Yes.
And his charts show, historically, when interest rates are rising, buyer demand increases and prices rise, which would at least, say, okay, well, 2022 in a rising interest rate environment, those buyers, maybe it's fear of missing out, or I already missed out, but let me get in now before.
It's because the economy's good.
Right.
The Fed's trying to slow down the economy. So they've got jobs, they're making money, they're wanting to buy a house. They got a family, they want to buy a house. So the economy's good, and I can afford the payment, they're going to buy the house.
Right, which is why we need that inventory section.
Yep.
Before we sat down, I started talking. We're doing some marketing in the office internally. It's totally anecdotal, way too early to draw any conclusions to it. But we're specifically marketing a homeowner database and basically saying, hey, would you want to get some information on how much your home is worth, and are you interested in selling? I am shocked the number of people that are replying to that marketing piece that are saying, yes, I'm selling in the next 3 months. Yes, I know.
3 months, wow.
And 6 months. I mean, we're giving them kind of some choices. Now, again, it's a marketing campaign, way too early. We're not starting to see the funnel isn't come down to actual listings yet. But it feels right. And if I have been a seller and I'm looking at, my gosh, 20% appreciation, 20% appreciation, where do I go? I have mixed feelings about it, because if sellers are like a little nervous, that says, hey, maybe we're at the top of the market now, it's time to sell. Well, that translates into other people. Maybe we're at the top of the market, let's not touch it. But with rates being what they are, and I'll say what I've said before, if you find a house that you like and you can land on that house at a 4.5% interest rate, or even a 5% interest rate, buy it, right? Buy it. Now, if the rates go down a year from now, okay, well then call Brett and refi into something better.
I had a 5.5% interest rate once. I thought I was the smartest guy in town.
Right.
Yeah.
Right. Because you also have an experience at a 15% interest rate.
Correct.
And when I got into the business 35 years ago, my broker did a backflip. I'm in the business for 3 months, and my broker at a sales meeting says, "Oh my gosh, interest rates are sub 10%."
Which I never thought I'd see early in my career.
Well, that's what he said.
Yeah.
He said, you're never gonna see this ever again. Go out and sell everybody a house that you possibly can, because we're never gonna see. And that was my first 3 months in the business, and they might have bounced up above 10 at some point, but they have progressively been going down for the last 35 years that I've been in the business. So at some point, unless we're gonna go to zero or negative like Japan, I guess rates have got to go up. So real quick, and let's get off the interest rate thing. Fed came out last week, did their meeting, did their 0.25% basis hike, and I believe said they're going to raise pretty much at every meeting 0.25% for the next 5 or 6 meetings. I think that's what I heard. Is that baked in to the mortgage market right now, or is that something that for every few months now we're going to be hearing, oh, the Fed just did a 0.25% basis point hike for the funds rate, and we're just going to constantly having this interest rate narrative, or are we going to or is that baked in? I guess that's what I'm seeing or asking.
Well, it's probably baked in, I would imagine, and I can't imagine it's not. What I expect to continue to be a big relevance is the comments after the announcement. Those are always a big relevance.
The balance sheet stuff.
Yeah, all that stuff, what they're doing, what they see, which way the economy's going, is inflation temporary or is it permanent, all that kind of stuff. And those comments are what really drive things.
Right.
So if we would have seen a 0.5 point increase in interest rates and the Fed funds rate, we might have seen an improvement in the mortgage market, because it's very aggressive against inflation.
Right.
And inflation is the enemy of the value of mortgages. So
right.
It remains to be seen, but I think it's built into the market, and then how quickly they dump off that balance sheet is going to be a big deal too.
Right.
So
yeah, that seems to be the concern.
$9 trillion worth of MBS on their balance sheet,
right.
and Treasury. So it's a lot of money.
So what is the plan? I know they made comments that they're going to start scaling that back, but is that really the question? Is what does that mean? How quickly they're going to?
It is, to my mind. How quickly and when is it going to happen, and
right.
how much is going to? Yeah.
It's funny
because the market's got to absorb it.
Right. Well, you turned me on to Barry Habib and MBS Highway and all the rest of that. And I'm not a mortgage guy, but I find his data just fantastic, and I'm obsessed with it now. I'm learning it though. So I'm learning. Oh my gosh, okay, there's a lot going on here. You had mentioned the Fed comments. I said, okay, yeah, that's good. Okay, we'll pay more attention to the comments after the meeting and how to interpret those than a 0.25% basis hike.
Yeah.
But
yeah.
interesting.
Barry Habib predicted our price increases during the last recession.
I did not.
Yeah, he predicted them, and what he uses his prediction is actually very sensible, and I believed it at the time, and it came true. And that is because of the recession and the huge number of foreclosures, the banks would quit financing developing land.
Okay.
And the builders would quit building because they didn't want to compete against the foreclosures.
Right.
So if you stop developing land, how long does it take to develop land in places like the West Coast?
Right.
It takes forever,
Long
right?
time.
Places like the East Coast takes forever.
Yep.
So by the time they got the land developed, the demand would pick up and prices would start to
And
climb.
there'd be a shortage in supply, and
Yep,
there you go.
yep, and here we are.
Smart guy.
Yeah.
Interesting.
Yeah.
I don't know if I shared this with you. I just did an interview with Mike Marconi at Orange Coast Title, and he's the first interview I've done after I interviewed Ido Benzivi. Ido's interview will be already have aired, so if you're watching Brett's interview on Facebook and you haven't seen Ido Benzivi's interview, then stop right here, go back, watch Ido's interview, and then come back here with Brett and I. But he's fine. He does a lot of commercial stuff. He's kind of like the Amazon warehouse guy, but he's building 5,000 to 10,000 residential units in Moreno Valley. He's grading this year and going to go vertical next year. Half of those will be, probably, I don't know. I'm putting words in his mouth, but I'm assuming half or so are going to be multifamily. But what he's approved is single-family residential. thousands and thousands of units right in the heart of Moreno Valley, which is what we've needed
Yes.
forever. And I get excited when I see someone like him who's, puts his money where this is his stuff. He doesn't have a board of directors, or maybe he has a board of directors, but he's not a publicly held company. He doesn't have shareholders he's got to answer to, like, KB or somebody like that. But that's interesting. So Barry predicted that appreciation just based surely on the fact that the risk reward of building houses was going to be too high, and then ultimately when we came out of the recession, then there'd be a supply and demand problem.
Yep. Yeah,
And
and that's really, that's why I listened to him. I've listened to him since like 2000. And,
Wow.
Yeah.
Well, I haven't. I've only listened to
Yeah.
him for a couple of years and in earnest just for a few months. And interesting. So I guess this is a commercial for MBS Highway. Barry Habib and his son is what, Dan?
Dan, and there's another one too. I can't
Yeah,
remember.
they've got an interesting thing going there. I didn't realize how much information they were providing to your industry. So interesting stuff. However, very little of that is public though. That's totally subscription.
Yes.
Yeah. So
It's really impossible to get without
yeah,
subscription.
pretty. Yeah. So don't you can Google it, but unless you're willing to pay, they're not gonna kick that stuff out too easily. Interesting. Okay. So so what are you doing? What are you doing at Loan Depot that's preparing you and your business plan and your loan officer's plan for 2022? You mentioned a couple interesting loan products a couple of months ago, or not even that, a few weeks ago. 95% non-conforming and stuff. Anything kind of exciting that's going to help address whatever concerns we may have in 2022?
Well, I think it's exciting to, there's several fronts that we're working on as a company. One is probably not that exciting to you, but we're working on rejuvenating or motivating or I don't know what the right word is, but retraining our sales force to be more consultative and less order taker. So in the refinance market, you're kind of an order taker, because business comes in and you just move on and move on and move on to the next one.
Yep.
And we're trying to work at being more consultative with Barry Habib stuff, with some stuff on mortgage coaching and consulting on that. So that's one of the aspects we're trying to elevate the game of our loan officers, which is always important. And then the other thing that really would excite a realtor or a home buyer would be products, additional products. So, one of the big gaps in the market is in Southern California has been the Fannie Mae Freddie Mac loan limit and above. You go into Orange County, you've got the high balance, and then you've got jumbo. LA high balance, and then jumbo. Out here in the Inland Empire, we're stuck with smaller loan amounts. So, which are significant loan amounts in other parts of the country, but they're small for here. And so we've come up with a couple of products. We have a 95% jumbo, which is an exciting product that I really like. We have two other products that are also exciting. One's a 95% jumbo, one's a 96.5% jumbo. Yep. So 3.5%, 5% down, you can buy a house.
Right.
Those two require a little more cash reserve than the other one. That's why I like the other one. But with that low down payment, if someone doesn't want to cash in some of their investments, they can buy a house with a low down payment because we'll use the investments for their cash reserve.
And you had first mentioned this to me a bit ago, I don't know, a month and a half ago. I think you quoted a rate. We always got to be careful. I understand you guys hate that. Well, I think it was like 5 3/4 or 5.5. Well, that was a little bit ago. So now that product might be 6 or north of 6.
Yeah, it's going to be in the 5 somewhere most likely. But you have to remember, included in that cost is the mortgage insurance.
Right.
So there is no mortgage insurance premium, which comes with the low down payment product.
Well, that gets back to you just saying you want to be more consultative in your business, a better consumer experience.
Yep. Mm-hmm.
And man, I got to tell you, if we're not all going that direction, we're all going to be in a world of hurt.
Oh, yeah, without a doubt.
Yeah, because the consumers, there's too much ability to point and click, and there's a lot of information out there, but there's a lot of bad information out there. For example, that product, if you're not, kind of really aware what a 95% loan to value on a jumbo loan is at a higher interest rate, or a 96.5%, loan at a higher interest rate, I get excited when I hear that. A lot of other consumers are like, why? Well, I have to pay what? I got to pay a 5.5 or 5 3/4% interest rate? Well, yeah, you do, because it's basically a jumbo loan, and it's got no down payment basically, 3.5, 5% down, and no mortgage insurance.
If you have investments that are returning significantly more than 5.5%, it's a fantastic deal.
Right.
And can you find investments now that return more than 5.5%? percent, you can.
Sure.
I can point you to several.
Right.
And it makes a lot of sense.
Well, that
If
gets
you
where-
keep your investments rolling, and then you would, keep your mortgage. Yeah.
So we got to educate that consumer, and that's frankly where you come in, and your real estate realtor relationships come in and say, I've got a very specific buyer over here. This product might be great, as opposed to us doing what we've been doing. Let's chase that lowest possible interest rate we can get. Well, heck, if I don't have to put 20% down, I can come in and put this down. Maybe I'll pay a higher interest rate for all the reasons you just said. I've got my other investments doing a little bit better.
I had a really smart lady one time. She wasn't well educated, street smart, from East LA. We lived in Portland, and I was doing loans in Portland. And her and her husband created a very successful business, and she's buying real estate. And one day the interest rates went up to 6, and I'm like, Alberta, the rates went to 6, and she's like, it's okay. I can make a lot more money on this than that.
Right.
And she was a multimillionaire.
Right.
And it's all in the perspective. So
Right.
it's interest rate's important, and keeping them down is important in your investments. But at the same time, the opportunity cost of missing out on investment.
Well, in that education of the consumer and that narrative of, and it concerns me. I'll be honest with you. I'm concerned about, are we as the industry going to be able to do what Roberta did and explain that, says, hey, you know what, a 4.75% rate, a 5% rate, a 5.5% rate, yeah, it's not as great as you could have gotten in 2021, but it's a darn good rate.
Yep.
And then we've got some education to do.
Yeah.
It worries me.
We're seeing other products gain prominence again. So one of the things I'm trying to do this year is promote more of the renovation products.
Yep.
So renovation has not been super popular. It's going to be hard to be popular now because there's so much demand on housing. But if you have a house that's not financeable, and someone doesn't want to pay cash for it, it's a way a buyer can buy a house.
Right.
So that's something that we can do. We're looking at seeing a lot more of what we call in our industry the non-QM business, which is non-qualified mortgage is what it means, and it's a long story what that means, but in any event, there's more risk to the lender on those, and they're more flexible.
Right.
So we're seeing a lot of that coming. That's in the form of loans that are more flexible for self-employed buyers or for investors into rental housing.
These are basically loans that are not being sold to Fannie and Freddie, and
They're not being sold to Fannie and Freddie. They're being sold to hedge funds and things like that.
what we used to call those portfolio lenders.
Portfolio lenders. Yep.
They basically do the loan. They got kind of write their own rules. They do what they want. Non-QM, non-qualified mortgage, which is. I'm oversimplifying it, but Fannie, Freddie. So you think that's going to be a bigger part? I'd love to see those. Well, who was the biggest portfolio lender back in the day? Like World Savings, or
probably, yeah,
or one of those guys. And it's so funny because they were just kind of part of the entire fabric of our business.
Yeah, there was Amundsen, World Savings, Great Western. There was a whole bunch of them. Yeah.
And they're all out of business now.
They're all gone. I think. Let's see, a couple of them are Wells Fargo now.
Okay.
They got bought in other
crazy.
people.
Oh my gosh, boy, we're just a stroll down memory lane.
Yes.
Okay, not that I want to end, but if we're getting closer to ending it, you were telling me briefly about a couple of good quality, or at least one specific good quality borrower. And this is not a good story, quite honestly, that that in effect has been writing these offers. You're going the extra mile. You're calling the listing agent on behalf of the borrower and of the agent writing the buyer's offer, saying, hey, I got a great buyer here. This is the FICO. Everything about him's great, and you're basically not having any success. That's a story that a lot of people can tell right now. So, which, by the way, and how much this particular borrower, this example of many borrowers you're working with, they're losing out basically the cash offers, better cash offers generally?
Generally, or very large down payment offers.
Okay, and your down payment,
So my story is I have what would normally in most markets be a very strong borrower.
Yep.
Okay, very strong borrower. High FICO, like 750 or above.
Okay.
High income, income enough that it's just a high income and their debt income ratios are low. I'm hitting on all cylinders. He's got his own money for down. Unfortunately, it's only 5%.
Right.
And so the sellers or the listing agents are freaking out because what if the appraisal comes in low?
Right.
Yeah, you offer $30,000 more. What if the appraisal comes in low?
Right.
And so we arrange for a gift from a family member in case that comes up. Still, we're not getting those offers.
Right.
And the realtors made like 10 offers for those buyers over the last 3 weekends. And it's very tough for them because
And
it's
it-
a
and
young
it-
couple with a little kid, and
Yeah.
they want to have a place for their baby to play in the backyard and barbecue with their friends, and they're having problems finding that. And it comes from a really good referral source for me, a good friend of mine that refers me some business, and it's unfortunate. It's really frustrating. So.
And in any other market, that would be a great buyer.
He would have
you
found a
know?
house a long time ago.
Right.
Yeah, first weekend out, he would have found a house.
Right.
Because he's, in any other market, that's a great borrower.
Right. But we're not in that market.
We're
And
not
we
in that
haven't been
market.
in that market for a while.
Long time.
And even though we've got some concerns with interest rates, the demand is still so nuts, and there's a lot of people with large down payments and cash. My heart aches for that borrower, or God forbid, or just a straight old-fashioned FHA borrower, even a vet, for gosh sakes. You got a veteran who wants to take advantage of their VA loan, and
Yeah.
they're getting like no consideration.
I did a loan
for
for
that.
a veteran out of your Moreno Valley office, and it's been over a year ago, and that guy probably wouldn't be able to buy a house now.
Right.
You know, it was one of John's clients.
Yeah.
And it's unfortunate. He's just a nice salt of the earth guy.
Yep.
And, you know, he was thrilled to get his house. I was thrilled to help
And
him.
it was a no down.
And no down,
traditional
VA,
loan. Yeah.
standard loan, nothing fancy.
Yep.
Just a good guy and a
Right.
veteran. He served the
Right,
country.
right,
You know,
yeah.
and we got that done, and I would be very worried about him now. So,
Yeah, and it's a heartbreak, whether it's the vets, which again, we all want to help the vets. I mean,
Correct.
but when you have sellers under real life circumstances looking at a cash offer as opposed to a no down VA or a low down 3% FHA or a 5%, non-conforming jumbo, whatever and like, yeah, I don't want to worry about the appraisal or,
Yeah, there was a.
it's so tough.
It seemed like there was a light at the end of the tunnel in December and maybe January, because I don't know if you remember, and maybe I'm wrong, but it seemed to me that instead of 15 offers on every house, there was 5.
Yeah,
And so that was a little bit of relief. And it looks like we're back up to 15.
we're
on
up to a
every
lot.
house. Yeah.
One of our agents in Moval, working with 3 separate buyers, had 3 offers out over the last 4 or 5 days. 3 different buyers, 3 different properties, good quality down payments, writing above asking, 0 accepted.
In
Not one of them
Upland,
got accepted.
in Upland, about 3 or 4 weeks ago, there was 15 offers on a house, and I had 3 of the pre-approved buyers.
Yeah.
Personally,
Oh.
that were working with me, and the agent said, "Brett, I know your buyer's good. I know your buyer's good." And
Which one?
yeah, I'm like, and
Right.
it's like, because I was calling him about each buyer, and I couldn't tell anybody that because I didn't want to spill the beans
Right.
and create an unfair advantage for anybody. But it's a unique market.
Did
It's-
one of those 3?
None of them got the house, and they all offered significantly more than what it was out on
Yeah,
the market
that's
for.
just
like
that's just
30,000.
nuts.
Yeah.
That's just nuts. Well, part of the story, if you are a seller, and we talked about this, and my example of, hey, we're soliciting sellers and we're getting some hits. My concern is you're going to have some sellers that say, yeah, I think now's a good time and I've done well, but where are they going to go? What are they going to replace it with? And
You've been in the business long enough to remember it, and I'll tell you, the early '80s were they kind of remind me of now. I don't know that we're headed there, but the Fed raised interest rates purely to slow down the economy.
Right.
And that's what they're doing. They want to stop inflation. And so if they're raising interest rates, that means the economy's good.
Right.
And so people are buying because the economy's good.
Right.
But sooner or later, something's going to start slowing it down.
Right.
And when that happens, it's kind of like when they used to in the school, in the elementary school, when they played that cakewalk game or something, you had to sit down in the chair.
Yep.
What's that game called?
that game.
Yeah, whatever
Yeah.
that game is. And you missed the chair. You don't want to be the seller that missed the chair.
Right.
And where you could have gotten $1 million for your house, now you can only get $100,000.
Right.
for them.
But that supposes that we're going to start to see values pull back.
I don't know that we're going to see values pull back, but I don't know that we'll have a permanent 15 offers on every house.
Yeah, but every time I start to think that things are going to slow down and we're going to see that, that kind of that peak or that leveling off, then again, I always go to, for years I've been saying, well, what if I want to buy a brand new boat? What if I want to buy a new RV? What if I want to go out and buy a new Honda off-road motorcycle or whatever? All of those fun things that I like to do, you still can't do any of that. And it's not just supply chain. I mean, they're used boat. I bought my boat story. That story I told about last year's forecast or the year before forecast. It's a used boat. I'm going to sell that boat for 20% higher than what I bought it for. A used boat. That just doesn't happen. You know, I was looking for a new motorcycle to run down at Baja, Honda 450X. You cannot buy that bike. It's not available. So
that's a good economy.
it is a good economy.
And it's
Right.
also people expecting to have to pay.
True.
They're believing inflation is here to stay.
Right.
And that's not a good sign.
It's not. It's not.
Yeah.
Okay.
Not
So
to be negative. I don't think we're going to have a bad year this year. I think the real estate year is going to be a great year.
most of
Sales.
the people I'm talking to are concerned, but think it's going to be a fantastic year.
Yeah.
And that's kind of how I feel.
Yeah.
It just feels like something's going on, which is why I'm excited to see Chris Thornburg on April 6th,
Very much
because
so.
we'll see what he's got. And I know he's given this a lot of thought, and I always kind of, you know, I don't use the term puppy dogs and rainbows with Chris a lot, but there's been a lot of, I mean, yeah, I think, again, I'm paraphrasing him, but I think he said something to the effect, it's been very fun to do his talks over the last several months, because for the last several years, it's pretty much been kind of cookie cutter, very easy. He says now things are getting more interesting. On where this is going to go and what it's going to look like. So,
Do you think economies will be more regional again?
I don't know.
Because in the past, there's been very differences. I mean, one part of the country's dead, dying, another
Right.
part's doing great,
Right.
and they swap spots. I kind of wonder if that's coming back more.
Well, maybe so, but if
Mm-hmm.
that's the case, as our Inland Empire market, because you and I, for the most part, are Inland
Yep.
Empire guys, I mean, we're positioned to do fantastic.
That's what I think,
mean,
because
you know,
of the way the commercial market's going.
Right.
Yeah.
Well, just that, and again, affordability. We
Right.
can say, you know, prices have gone up, but yeah, but compared to what?
Right.
You know, I did a market snapshot of value. I don't even sell Huntington Beach. I did a Huntington Beach median price in my last market snapshot, which is over $1 million for the median price, basically bungalow in Huntington Beach, $1,050,000. And I think the highest one I'd done in the Inland Empire, I think I did Corona or Rancho or something like that, and it was in the low 8s. So if you're in the Inland Empire, you're only $800,000. Oh my gosh, it's a lot of money. Well, yeah, it's a lot of money until you drive 30 miles west.
You don't even have to go 30 miles. Just go to Laverne.
Right.
It's shocking to me, the difference in price between Laverne and Upland or Rancho Cucamonga.
Yeah. Which makes it attractive. Which
Yeah.
means, you know, even though we may be concerned,
Yeah.
you know, we talk about regional. Let's just look at a region over here or there, and then how attractive do we become?
And what we've had in those past economic updates, they always show about how everybody's moving from LA and Orange County here.
Right.
So,
Right.
and we're not having the loss of population some of those places are.
True.
Yeah.
Interesting. Well, look at that. We've
Fascinating.
solved all the problems.
I'll just like that.
Brett, thanks.
Enjoy
So
it. Thank
year
you.
4 in the books. Thank you so much.
My
You'll
pleasure.
see Brett's interview pretty quick. Again, today's March 22nd, so you'll probably see him by the 27th or 28th. So we have about 5 speakers left, and then Chris Thornburg on April 6th. So watch on how you can see that and how we're going to stream it to you. So Brett, thanks again.
Thank you.
All right, more to come.